Hello everyone, this is Tejashwini Chiranjeevi. In this video, let's try to understand about the capital gain questions of your CA final direct tax. Okay, Hari had acquired residential property on 15th of April for 9 lakh rupees very well, and he decided to sell on 3rd May to Pari, and he has received the advance of 25,000 also. However, whatever the advance of 25,000 which Ari has received from Pari, it was forfeited. That means the entire advance amount is been forfeited by Hari because she did not pay the balance amount. Okay. On 3rd June 2024 again, he has sold this house to Suri for 43 lakh. Now the actual sales has happened. On 4th of April 2024, he had purchased a residential house of 7 lakh. See here, try to understand the portion of the question part by part. He has once forfeited this point. Okay, this goes under one adjustment. And on 3rd April to 2024, he has made the sales. This is one point you need to keep in your mind. On 4th April 2024, he had purchased a residential house in Delhi, 7 lakh. And they have given some story where he was staying on rent and all fine. And he paid the full amount as per the purchase agreement. However, Ari did not possess any legal title till 31st of March 2024, as such transfer was not registered with the registration authority. He did not register the property before 31st of March 2025. That is the PY which is applicable for us would be 24-25. Before that date, he did not occupy. He did not consider. Okay, he did not register the property which he had purchased, the Delhi property. Hari had purchased another property very well in Chennai on 14th of October 2024. Very well, with rich fellow from Mr. X for paying by paying 5 lakh, and the purchase was registered with the appropriate authority. Find the capital gain in the hands of Hari for AY 25-26. Indexation is also given. Now, first of all, tell me, when is the property sold? Is it before 23/7/2024 or is it on or after 23/7/2024? Because the capital gain has underwent a lot of changes in AY 25-26. So you need to understand when the sales has happened. Is it before 23/7/2024 or is it after 23/7/2024? Obvious, it is before 23/7/2024. Okay, so the old provision prevails and you can do the solution as usual. Now, for whatever the advance which has been forfeited, correct? Section 51 states that if you have forfeited any advance, if it is on or after 2014, very well, whatever the advance which has been forfeited, that will be considered as your income. Hey, how will that be considered as your income? Simple concept, people. You have your thought fixed stating that, okay, I'll sell that property to Pari. She'll give me the money. She has given you the advance of 25,000. If the property was sold as on that date only, you would have recorded capital gain over there. Now the amount of partial, a small portion of the amount is received as advance and it is kept with you, and you are not giving it back because the property is not transferred or she is not given the balance amount. Whatever 25,000 which you got is your income only, no? And now it has to be taxed under the income from other sources in that respective year in which year you have received, if and only if it is received on or after 1/4/2014. If it is before 1/4/2014, then whatever the 25,000 rupees income which you have, and in order to buy the property you have paid 9 lakh, that is the money which went out. Whatever 25,000 which you got is money which you got in. Now you have to adjust your cost of acquisition, 25,000 which should be adjusted with your 9 lakh. Clear? 9 lakh minus 25,000. So your 8 lakh 75,000 would be your cost of acquisition, net cost of acquisition that you need to consider for your calculation of indexation. Are indexation is available? Yes, it is available. Why? Because this transfer has happened before 23/7/2020. Very well. And this has been sold after this date, and he has purchased two properties, one in Delhi and one in Chennai. Date becomes very important. See here, one is after 4th April 2024 and the another one is 14th October 2024. In order for you to take the exemption under section 54, what you need to do is that you need to buy the property before the within 1 year, before 1 year from the date of transfer, before that 1 year or after 2 years. Why is this provision prevailing, people? See, common sense here. if you're thinking of buying the property, and if you're thinking, like, okay, I want to get a capital gain exemption under section 54, let me do one thing, I'll sell the property and I will buy. Before selling the property only, you got some good property. That is, you got it at a reasonable price and you got all the conditions satisfied from your side, and you felt, okay, I'll buy this property. Will you wait till the property is sold and then to buy this property? By that time, some other fellow will come and take. So you're thinking now, I'll buy this property now. And within some 2-3 months, whenever that my property has been sold, so that I'll get the capital gain exemption over here. That is why section 54 has given you the option. Genuinity is the case here. You're thinking of buying and you want to actually buy. Genuinity, substance over form is being looked under. So they're like, okay, we'll give you the exemption 1 year prior to the date of transfer, within 2 years from the date of transfer. Before that date, not financial year. Before that dates you need to consider. Clear? Very well. See now, 4th April 2024 is within 1 year before 3rd June 2024. No, 3rd June 2024 before 1 year. And 14th of October is within 2 years from the date of transfer. So very well, both the in both the places, 7 lakh and 5 lakh, both exemption you can take under section 54. Now we have splitted the question. Now let's try to understand how the solution goes. We already know the sale proceeds is 43 lakh. Where is it? Where is it? Sales is 43 lakh. Split the question here in order to understand. Sale proceeds is 43 lakh. Index cost of acquisition is available. Array, cost of acquisition should be the point now. Array, it is transferred before 23/7/2024. Indexation is available. So what you will do, first of all, you should adjust the cost of acquisition with the advance forfeited point, which I have already explained, as this is before 1/4/2014. Minus 25,000 from 9 lakh, you will get 8,75,000. From that, you will take the indexation as usual. I assume you already know the indexation, so I'm not explaining it again. So 363 divided by 105. Year of transfer divided by year of purchase. Indexation in the year of transfer, indexation in the year of purchase. So 30,25,000 is the point of indexed cost of acquisition that you will take. 30,25,000. Now your LTCG is long-term capital gain is 12,75,000. Now tell me people, whatever the long-term capital gain that you've recorded, is it exceeding 2 crore or less than 2 crore? Is it exceeding 2 crore or less than 2 crore? It doesn't exceed 2 crore. That is, it is within up to 2 crores only. So now you can take the exemption for both the properties. Suppose your LTCG is after, that is, if your LTCG is beyond 2 crores, then you can take only for one property, you can take exemption. As this is less than 2 crores, you can take for both the properties. Now wait, it's not yet completed. See here, there is small point which they have given. He has paid the amount for this Delhiwala property. He has paid the full amount as per the purchase agreement. He's a genuine fellow, good fellow. Hari paid the entire amount. However, Hari does not possess any legal title till 31st March 2025. That means he's not having the property written in his name before 31st March 2025. As such, transfer was not registered till the registration authority before that date. Fine. Now you have to look into the point of substance over form. Here, is the attitude of Mr. Hari genuine in this case of buying the property only? Yes, it was genuine. He was a good fellow and he has transferred the property also. Transferred the amount also. But he does not possess any legal title. This doesn't abstain him from getting the exemption under section 54. And this has been told in the case laws Balraj and Shehzada Begum. What is this case law states is that very simple. Now, in order to claim section under exemption under section 54, you need to buy the property. You have bought the property. In order to buy the property, you have paid the full consideration. But you have not registered before the title. That is before the 31st March. That is, the title should not be necessary for you to claim the exemption, as the taxpayer has already paid the full consideration for the purchase agreement within the time frame mentioned. He would be eligible for exemption under section 54. This is what I explained. This has been told in Balraj and Shehzada Begum. Okay. Very well. So now, under section For this Delhi wala property, you can take entire 7. For Chennai property also, you can take the entire 5. Your LTCG has become 75,000. Clear? Understood? Great. So in respect of the second question, I'll just tell you the story, what has happened and what was the court case which was contended. Okay. This fellow, this is actually a case law which has been explained, which has been given in the form of question. So let's see. So this is in the case law of Anand Basappa. Anand Basappa. This is the case law. See here, what this fellow did was, he actually purchased, he had sold a property, he had got the capital gain. Suppose, let's consider just an example as provided here. His capital gain is exceeding 2 crores. Okay. So now what is thinking? Let me do one thing. I'll go and buy a property and I will take the exemption. Okay. So with regarding to this exemption, what he has done is that he had purchased a flat, one flat. Adjacent to that, he had purchased another flat. Next to that, adjacent flat only. And he had given to the builder to make it a modification in such a way that these two flat becomes one flat. These two becomes one. By creating a door between the apartments, he had created it as one flat. Now the point comes, this fellow, whatever one flat he has purchased, even if he had purchased from two different persons with the two different sales date and with separate tenants being in that place before it was purchased by him, it was kind of two different properties, but he made a modification to move into one. Okay, to make it as one. Now, as this capital gain is exceeding 2 crore, we already know if the capital gain exceeds 2 crore, you can take the exemption under section 54 only to the extent of one property. You can't take two. Correct? You can take only one. So now the assessing officer is like, no, I'll not give the exemption under section 54 for this is considered as two properties as per the provisions. So what this fellow did, this fellow went into the court of law, and what the court of law decided is that, array, you have purchased the property. It might be from two different persons, two different kind of occupations done before, or whatever the situation might be. But you have created one unit by opening the door between the apartments, and therefore these flats were occupied by two different also. It's fine, whatever the thing might be fine. The court observed that these were not the grounds to make the assessee did not have the intention to purchase the two flats as one unit. You can't see that that fellow intentionally purchased these two flats to make it as one. So now the assessing officer, it is not right on the assessing officer's side to restrict him to get only exemption for one property only. These two flats shall be considered as one residential house. Hence, he can take the exemption under section 54. See, the same thing is provided in Anand Basappa case. He has opened the unit between the units. He had placed a one unit door he has placed between the apartments, and hence the court was like, you can give the exemption with regarding to the purchase of both the flats to form one residential house, and hence this Mr. Ganesh is entitled for exemption. That is what being given in the question, nothing else. He has purchased two property, two different sales deed were there, two different persons were saying he had purchased it from two different properties. To make it as one residential property, he had given it to the builder. Exemption under section 54, he had taken for both the residential flat, but the assessing officer is like, no, we'll not give for two, we'll restrict it to one only. And the flats were sold through, and all these points, whatever is that, the contention of the assessing officer is not right, because as per the Anand Basappa case, it shall be considered as two flats to form one residential house. This becomes the keywords. This becomes very important. Clear? Therefore, the contention of this assessing officer is not correct. So the next question number 3 and 4 are similar, like case study based questions. You can read it by yourself. Those are theory basically. So let's do some practical points. Question number 5. This fellow, Xavier, this fellow has taken a loan under the registered mortgage deed based on the house he has taken, keeping the house as mortgage. He has taken the property on lease, which was purchased by him for 5 lakhs. He has purchased basically in 26/5/2002 for 5 lakhs. This said property was inherited by his son, by Abraham, in 2009 and 10. As per his will, he has given the property to Abraham. What this fellow Abraham did was, whatever the loan which was outstanding to the extent of 15 lakh rupees, he paid the loan amount. And this said house property was sold by Abraham in 16/4/2025 for 55 lakhs, examining the taxability over here. So this is a very small, cute question which looks, and it has various alternatives. Let's try to understand everything. See, what has happened, the crux in this case is very, very simple. They have asked you to calculate the capital gain. You have to see first, whenever you see a capital gain question, that is, when was the sale happened? Is the sale happened before 23/7/2024, or is the sale happened after that? If it is before, cool, there is no problem. The normal provision sustains. So 16/4/2025. Can you take indexation? Absolutely, yes, you can take indexation. Okay, when was this property sold? This property was sold on this date for 55 lakh. Sale proceeds 55 lakh. Okay. Now, what they have told is that this fellow was purchased. Tell me, the sale of property which was done by Abraham, is the property purchased by him or was it inherited by his parents? It was inherited by his parents. Means under section 49 subsection 1, you can consider the cost of your, you have to consider the cost of your previous owner as your cost of acquisition. Correct? Very well, no problem. Fine. Now the point comes, for the purpose of indexation, will you take right from the time where you got the hold of the property, or will you take the indexation benefit right from the property held by the inherited, that is from the previous owner? You can either select any one. Okay. The plain reading of the provision states that you have to take the indexation benefit right from the time where you got the hold of the property. But if you go for the case law, that is, which is given in Manjula J. Shah case law, it has been stated the property of the previous owner, it has been inherited by you, and whatever the cost of the previous owner if you're taking, means it is logical for you to take the indexation benefit also right from the previous owner only. That is what being stated here. Okay, this case law is very important. Manjula J. Shah. Please remember this case law also. Manjula J. Shah case law. Okay, so now you will be taking the indexation right from 2002, that is 105. You will be taking the indexation. Very well, fine. You will take the indexation cost of the previous owner 5 lakh. Year of transfer, CII of the year of transfer, and this is the year of purchase. You will take right from the previous owner. Fine. But there is another point given. Abraham paid the outstanding amount which is taken loan for this property in order to get the property to his hand. He has paid 15 lakh rupees as loan settlement. Correct? See, think here. You think in a very common sense way. This 15 lakh rupees, whatever he has paid to acquire, to get the hold of that property only, no? So, logically, this 15 lakh should be considered for the purpose of indexation also. Should be considered for the purpose of cost of acquisition also. That is what we have done. That's whatever 15 lakh rupees he had paid, in which year he has paid. He had paid in 2009 and 10. 2009 and 10 PY, it is 148. We will take the indexation right from the year of purchase. That is basically in the year in which the loan has incurred, and the numerator would be the year of sale. You would consider this, and the capital gain would be 92,375. Suppose if you take an alternative, suppose what is the alternative? If you just take the plain reading of section 48, you take the indexation for this cost of acquisition right from the year in which you have got the property. Plain reading of section 49. What you would consider? You would consider the in CII in the denominator of the year in which you got hold of the property, that is 2009 and 10. 148, numerator will be 363. So this point would be so much. So the amount paid by Mr. Abraham would be whatever the calculation which you have done, the same understanding goes good. And now your capital gain will become 5,94,595. Array, an option is given for you. Which one will you select here? Obviously, low capital gain. No. The place where the capital gain is less, you will consider that. And so the next question, question number 6. This is the question of which deals with the section 54. Okay, 54G. Gamma Limited, this unit was shifted. That is, this unit was basically shifted its industrial undertaking to non-urban area. The company sold some of the assets and acquired new assets in the process of shifting. See, if you sell an industrial undertaking, you will get an exemption under section 54G. In order to get that exemption, the transfer has to be taken before 1 year from the date of transfer or within 3 years from the date of transfer. This is the timeline. Okay, and what is the exemption that you are going to get is that whatever is the cost of new asset which you have purchased. If your capital gain is more than the cost of new asset purchase, then it will be excess of that amount, excess of your cost of new asset purchase. Suppose your capital gain is 10, just an example, and the cost of asset is 8, 2 will become taxable as your under your income tax. What about if your asset which you purchase is 7, capital gain is 7 and the asset is 8, then in that case nothing will become taxable. That is basically they just want you to invest that capital gain amount which you have got back into the same industrial undertaking only in the form of machinery, in the form of plant and machinery, land, building. But remember, furniture is not covered. If you put the money into the furniture, that is the capital gain amount which you have purchased for the furniture, it is the cost of new asset of the furniture will not be available for the purpose of exemption. Exemption will not be available if you put the money into the furniture. Clear? Great. See, now section 54 says that you have given with the sale proceeds. What is the sale proceeds provided? 8 in case of land, building 18, plant and machinery 16, furniture 3. So now can I say whatever might be the capital gain or capital loss, whatever you get in the furniture, that will not be affected for section 54G. Only these 3 will be in focal point. The cost of acquisition was 0 and WDV is so much and the cost of asset which is purchased is so much. Now tell me what has happened in case of sale proceeds. This land, tell me, are you going to, how much is the depreciation that you would charge? Arey people, there is no depreciation for land. So hence this WDV is nil. It means whatever is the actual cost, the same thing prevails. That is what it means. WDV in terms of section 50, there is no depreciation that is charged. The actual cost itself becomes the value which would be carried as a WDV. Okay. See now, in case of land, which is a non-depreciable asset, the land which you have purchased is 8 lakh. Cost of acquisition, how much you have bought it at? 4 lakh. So what will be your LTCG here? 4 lakh. Now tell me how much is the capital gain exemption which you get under section 54G before taking the exemption under section 54G. You have to see first of all how much is the capital gain exemption that you actually have. How much is that you already have? See, whatever is the purchase which you have made. Do the total 4 plus 7 plus 17. What is the total, people? 4 plus 7 plus 17 will be 28. Everyone. 4 plus 7 plus 17. Correct? No. 28. So 28 will be your capital gain exemption that you can take, that you can utilize. You can take that exemption to the extent of 28. 2 is not allowed. So 28 you can take. Out of 28, people, see, short term will be bearing the normal tax liability. However, in case of long term, you have the little less rate of tax. No, 12.5% you have. Correct? 12.5% you have. This is sold in March 2025. So this is going to be on or after 23/7/2024. 12.5% is the long-term capital gain that you are going to charge. If an option is given to you, you take it for the 12.5%, yeah, or you take it for 30%, which one will you tell? Will you be such a good citizen stating that no, I'll pay 30% tax only? Please be rational. There will be no such person who will say, I'll pay 30% tax where you have the option of paying 12.5. That is what we are doing here. See, less the capital gain, less will be the tax that you pay. So now your preference is to exhaust whatever is there in the short term first, and then remaining you will take and will go and put it in your long term. Correct? Now, keeping this point in mind, I'll come back to this point very soon. Okay, you remember that 28 lakh very well. Sale consideration for building is 18, for this is 16, and for furniture will keep it aside. Okay. WDV is 4 lakh and 50,000 over here. Your STCG, people, you guys remember, no, the depreciable assets, there will be no concept of long-term capital gain. For depreciable assets, it will always and always be short-term only. So, this is also short-term only, but however, 54G you will not get, however, this is short-term. Short-term capital gain is so much. Now tell me whether section 54G exemption is available for building? Yes, very well. Plant and machinery? Yes, very well. Furniture? No, 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 you will not get it. So to what extent you can take exemption under short term would be 25 lakh. Correct. How much you already have? 28. Out of that, primarily first you will exhaust building and plant and machinery. Correct. 25 lakh you will exhaust first. And then whatever, after exhausting this 25 lakh over year, for the building and plant and machinery, the short term capital gain becomes zero. Correct. Now tell me how much is the capital gain exemption that I was eligible to take under section 54G? 28 lakh. Out of that 25 lakh I've already utilized here. Meaning how much do I have? 23 lakh. So this 23 lakh whatever is considered here is nothing but 28 lakh minus 25 lakh whatever you have taken over there. Remaining amount only you have got here 3 lakh. So you are paying the capital gain tax for 1 lakh under this category. So what will be a taxability? Long-term capital gain of 1 lakh which will be taxable at the rate of 12.5%, and furniture whatever you have decided or recorded here 1 lakh furniture taxable at the applicable tax rate. Okay. So whatever the points which you are seeing over here, whatever the notes which you are seeing over here, this is available in my Telegram channel. If you are not able to find it, you just text me over there in the Telegram only. I will send it to you. However, all the PDFs, all the informations, whatever I posted in YouTube will be available in my Telegram channel. If you want it, the link will be provided in the description. You can go and join and use the material. Okay. So whatever the point which I told with regarding to section 54G, the same explanation has been provided. So when you are writing in your exam, provide the information. Along with the providing information, you provide the working note also, because working note carry a same amount of marks with regarding to your actual practical solving of the questions also. So the next question number 7. What has happened? Here, the SSE was a company, he was carrying on the business, okay, and there was a machinery worth 4 lakh. And what happened? And the return on value of that machinery as on 1/4/2024 is also given. And what has happened? Because of he had taken and he had insured that machinery also earlier very well, and the fire broke out and the properties that particular machinery is destroyed, and the SSE company received a sum of 4 lakh rupees from the insurance company. Okay, this is the situation and CI is given, which is irrelevant in this case. I'll tell you how. See, basically, section 45 1A, which speaks about whenever you have received the money in the form of insurance company, from the insurance company you have received it. It will be not be taxable in the year of transfer, it will be taxable in the year when it was received. So remember, it was not taxable in the year of transfer, it will, whenever you have received the money, that year it will be taxable. Okay. So now, whatever you have received from the insurance company, that will be considered as the full value of consideration. And whatever the income that cost minus your full value of consideration, that will be taxable in the hands of the capital gains. That is one being considered. Okay. See, the full value of consideration is 4 lakh. What is the WDV value, people? The WDV value is 1,87,850. Now you would be wondering whether why this cost inflation index is not taken. People, that's short term here. Depreciable assets are always short term, and there is no indexation concept for short term. Understand it. There's no indexation benefit for short term. So where are you going to use this index, cost inflation index from? This is given just to confuse you, thinking that okay, so now I'll take this 1,87,500 and I will multiply it with 363 and I will divide it by whenever it was purchased. You will be wrong. Why? Because it's a short term. Short term, there is no indexation. So no overactions not required. Let's come to the reality. It is short term, no indexation. Whatever is the WDV, you will subtract it and you will get the short-term capital gain. Easy and happy. Clear? So the next question would be Tani. Tani, she basically purchased a land at a cost of 35 lakh very well in financial year 2004 and 5. And she held the same as her capital asset till 31st May 2023. That is till which PY? Till PY 23-24. Basically on 31st May 2023, she held it as capital asset. Later on, what she did was she went into a real estate kind of business and all, and she started a real estate business in 1st June 2023. Matter. Now, and converted this said land into the stock in trade of her business, or the said land, and when the fair market value was 202. She constructed 15 flats of equal size and she sold. The cost for each flat was 10 lakh. Construction was completed on 1st January in January 2025. She sold 10 flats out of the 15 flats for 30 lakh per flat, and the remaining 5 flats were held as stock. She invested, she took that money, whatever the capital gain, whatever the money, business income she got, she invested 50 lakh in NHI and 50 lakh in RECL and compute the capital gain, including clearly the reasons for this, and CIS is also given. See people, now try to understand a point over here. What is the situation that is happening is, first she was holding a capital asset. She converted that capital asset into the inventory. That is, inventory is nothing but PGBP. Capital asset is nothing but the capital gain. Now, two incomes are getting merged into one. So now try to understand this concept, which I am going to state it now, so that you will understand this question. If you understand the concept, basically, you will understand the questions as well. Okay. So now what has happened in this situation? You were having a capital asset. Okay. You had purchased this capital asset. Let's consider in 2000. We'll take this example only for CIF for that matter. Which year she has taken? She has taken in 2004 and 5. Okay. 2004 and 5, she has purchased what? She has purchased the property and she has held it as capital asset. So then later on what happened? In the date 31st of May 2023, right? What's the question stating? 2020, 31st March 2023, and she converted it on 1st June 2024 for that matter. Or 31st May 2023, she converted. See, this becomes your date of conversion. Okay. 2004 and 5, it was purchased. I was holding it as capital asset with the intention of keeping it in long-term capital asset. So slowly the area got improved, the situation got improved, and I feel I can sell it as flats now, and I can sell it as inventory now, make it as a 60-40 or 30-40 or 6500 flats and sell it. I can make some good income. Now she has become a real estate person and she has sold. On 31st of January 2025, what she has done is that she has sold 10 flats. Okay. Out of the 15 flats, she had sold the 10 flats. Till 31st May 2023, she was holding it as capital asset. Later on, she converted that into business income. That is basically she converted into inventory. That is nothing but the PGBP. Correct? Correct. Capital asset has capital gain and PGBP, that is basically inventory, has PGBP income. No. Everyone. It has what? It has business income. If you observe something carefully, area of understanding is that the transaction is the same, the property is the same. It is just been divided into multiple plots and it has been constructed a apartment and it has been sold. That's it. Nothing else. But the area, the property, whatever you are covering is one only. It is not multiple. So now comes the question, how will I divide capital gain and PGBP income for the same property? Nothing brainstorming over here. Think logically. See here, whatever the property which you have, suppose let's consider you are not converting the property, you are selling that capital asset as capital asset only. What price you would have sold? You would have sold at whatever the fair market value as on the date of conversion, you would have sold it to. So take up the same thing. The sale consideration in case of your capital gain would be, take up the same thing, sale consideration, that is the fair market value as on the date of conversion. Okay. In order to get that property, you should have invested some amount into it. Suppose let's consider, just an example, let's consider, here it is 100. Fair market value is 100 and the cost which is incurred to buy that is going to be 60. Okay, in order to buy that property you have paid 60. So how much will be a long-term capital gain, people? It will be 40, no? 40. So now the same property is being sold as a business income now. So now the sale price is nothing but, in case of your PGBP business income, whatever the sale you have given, whatever the amount which you have received, in terms of giving that flat or your plot for that matter, that will be your sale consideration. Let's consider the sale consideration is 125. Keeping it simple. Okay. In order to get to this sale consideration 125, this is the final amount. People, listen. This amount you're not receiving in hand. This is the amount which you're receiving in hand. Correct? Out of 125, whatever I have received, I have already taxed a certain portion of 125 already under the capital gain. Correct? Already under capital gain, already taxed. So now, I shouldn't be taxing it again. If I tax it again, it will be wrong. No? It will not be correct. Now what I will do, 125 minus 100, this remaining 25 becomes my PGBP income. How to cross verify this one? Very, very simple. My total sale consideration or the consideration is 125, no? Out of that, my actual cost of acquisition is 60. I'll subtract 60. So how much should be the remaining amount of 125 minus 60? How much should you get? 65. The entire 65 should be taxable, but if you observe something, it is taxable as 40 in case of capital gain, and it is taxable as 25 in case of your business income. Clear? It is taxable only here. It is the entire 65 is taxable ultimately, but under different heads of income. It will be taxable under capital gain provision is applicable. It is taxable under PGBP provision is applicable. Simple. Understood, everyone? I hope this is clear. I'll give you a very, very quick recap. See, first of all, what are you doing? You're purchasing capital asset. For this capital asset, you, after some certain number of years, you went and sold. After selling, what will happen when at the date of sale? Now the income whatever you have received at the time of transfer, it is taxable, and not at the time of conversion. It is taxable at the time of you receiving the money. Remember, capital gain is also taxable, business income is also taxable based on the calculation which we have understood now. Okay. So what has happened? Sale consideration in case of capital gain, whatever the fair market value. Suppose if you would have sold it, instead of converting, if you would have sold it, you would have sold it at fair market value only. At fair market value, you will consider cost of acquisition, you will subtract, and LTCG you will have. And the sale consideration is nothing but the actual money coming in over here. So actual money coming in over here minus something which you have already taxed it, considered as taxable under other income, you will subtract these things. So whatever you are considering over here, the same amount should come here. Okay. And the remaining amount will be taxable under the head PGBP. Clear? So now, based on this, we understand here. But the small catch, another point which you need to consider over here in this question is that she has sold 10 flats out of the 15 flats. So whatever the capital gain that is taxable, business income that will be taxable, will be proportionate basis, that is 10 by 15. It's nothing but 10 by 15 is nothing but 2 by 3, no? It will be proportionated to 2 by 3, nothing else. You can take 10 by 15 also, or if you want to simplify it further, you can take it as 2 by 3 also. Don't take it in percentage, that is not recommended. Take it in fractions only. Okay. See, fair market value is already given 210, and she constructed 15 flats. That cost of that flats is 10 and 10 lakh per flat. See, she sold 30 lakh per flat, that is 30 lakh into 10 flats is going to be 3 crore is what the money which she has received. Fair market value as when the date of conversion is so much. So now let's try to understand. So for the purpose of capital gain, first you will take, suppose if you would have sold it instead of converted it, you would have got 210 only. Correct? And index to cost of acquisition, or you have purchased it for 35 lakh earlier. For that, however, you are going to get the indexation. The year of transfer, remember, whatever the year of transfer will stop. The taxability happens in the year of money received from the business income. But your transfer indexation benefit will stop when it is converted. That is in the PY 23-24 PY, where is it? 23-24 only it is going to be stopped. So 23-24 PY divided by whichever year you have purchased, the indexation is given, you will take it and you will consider. Alright people, this entire point, whatever you are seeing is for the 15 flats, the total capital gain. We need it only for proportionate, no? That proportionate is nothing but 2 by 3 into this 1 crore 2,21,239. This proportion is this proportionate. If you do, you will get so much. And in case of the capital gain exemption over here, she has invested for NHI bonds and she has invested for RECL bonds very well within the time frame, that is within the 6 months from the date of transfer, that is from whenever this is received, you are going to consider it. But the maximum which is allowed under section 54 EC shall be only 50 lakh, not the entire amount. So 50 lakh is allowed as exemption. Your taxable capital gain is 18 lakh 14,000. Alright, business income, what you will do here? You have considered you have sold 10 flats. One flat is 30 lakh. So it's going to be 3 crore. Whatever you have considered here, this is for, remember, this point is what the amount that you are going to, sorry, 210 lakh. No, 210 lakh is the total for 15 flats. So how much is for 10 flats? Your proportionate capital gain that you are supposed to subtract, that is fair market value of the date of conversion, would be so much, and the date of construction shall be, sorry, whatever the cost of construction, 10 flats, 10 lakh rupees. So 1 crore will be the subtraction. So remaining the business income would be 60 lakh will become your business income, and your capital gain will be 18 lakh 14,159. So if you want this notes, whatever you are seeing, you can get that in my Telegram channel. The link is provided in the description. So the next question would be the question number 9. That is, let's get into it. Mr. Singh has the following transactions in the financial year. He has a rental income, rich fellow, at Bangalore 3 lakh, and standard rent is also having the standard rent. Municipal tax, water tax, current year and the arrears is also provided. Interest on loan, that is 1,50,000 is being paid as the interest on loan. Arrears for rent 30,000 is being considered. So now next the capital information is provided. They have asked you to calculate the shift out of the default tax regime very well. They have asked you to calculate the taxable income of Mr. Singh. See, if you remember, in your inter, you have done the concept of income from house property. That was one of the easiest concept, right? Only basic limited provisions, and it was a cute and a sweet concept. In case of in the income from house property, what you used to do, you remember you used to calculate GAV. Everyone, Ray, what is the provisions of GAV? How you were finding it? Fair rent or the municipal rent, whichever is higher. Whatever the answer which you got over here, that answer of your step number 1. Just a minute, what happened? The answer of your step number 1 or your standard rent, whichever is lower. So now whatever the answer which you got, that is the expected rent or the actual rent, whichever is higher. Correct? This is what we have studied in a inter-level only, inter-level of income from house property. Now, see here, if the any one information is absent, we are going to take the same amount to the next step. Fair rent is given in the question, very well, 2,80,000. Is municipal rent given in the question? No, municipal rent is not given. So, we will consider the fair rent 2,80,000 to the next step. Okay, 2,80,000 or the standard rent 2,50,000, whichever is lower or higher? Lower. So, 2,80,000 or 2,50,000, whichever is lower. 2,50,000. 2,50,000 is the expected rent or the actual rent, whichever is higher. We'll consider 3 lakh, whichever is higher. Array, basic common sense here. Fair rent is whatever the rent which is there in the locality. Municipal rent is as per determined by the municipality. Whichever is higher, you will consider very well. That amount what we have taken or the standard rent is as per the Rent Control Act. Array, Rent Control Act and has only told 2,50,000 is the limit. Why will you take something which is higher than the act which is stating? So we'll restrict it to 2,50,000 only. Now, Rent Control Act states 2,50,000. Array, you are a very intelligent fellow. You have made some modifications and everything, and you are earning 3 lakh. Array, pay tax on the 3 lakh only. No, why to take as per the act? They pay as per 3 lakh. That is why at last it is whichever is higher. Understood? Basic one. Okay. So water and the municipal tax paid 35,000 and arrears. And if you remember about the municipal tax, you remember, don't remember very well, no problem. I'll tell you the provision, so relax. Municipal taxes, whenever you are paying, you have to satisfy two conditions in order to take it as deduction in the during the period. You have to actually pay it. It should not be payable. You can't say that I'll pay it in the next year, I'll take the deduction in this year. No. I'll pay it in the current year. No. Whatever is the amount which you have paid as a municipal tax during the period for the current year or for the previous year, whatever, money should be moving out of the pocket. If your money moves out, then 35,000 1,50,000 is the money which moved out of your bank account. No, the entire amount will be available as your deductions under the municipal tax point. Okay, so the municipal tax which you are going to deduct is 1,50,000 plus 35,000. 1,85,000 is what you are going to consider as the deduction. What is the income that you consider? 3 lakh. Here it is so much. Interest on loan under section 24B is allowed as your deduction. So entire 1,50,000 for major repairs of the building. Fine, you can take it. In the case of arrears, whatever the arrear money, that is, you had a property, and that has been rented out. So now what happened with that regarding to that rent? That fellow, you went, you asked, you pleaded, you requested, you sent the legal notice, whatever you did, that fellow did not give you the money. That became unrealized. So what would have happened is that unrealized rent minus you would have done in the previous year, in which that unrealized rent has incurred. So whichever year you have actually realized that money, which you thought that money is completely gone, that money you recovered, the year in which you receive it, it will become taxable, and 30% of standard deduction under section 24A is available for this also. Okay, very well. See here, we'll first finish that first point. See here, income from house property, you have GAV. GAV is 3 lakh. How did you get this GAV? Where is it? See here, fair rent or the standard rent, fair rent or the municipal rent, whichever is higher, that amount whatever you got, which you have bought it, fair rent or the standard rent, whichever is lower, that is 2,50,000, and whatever the amount which you bought over here, that minus the that or the actual rent, whichever is higher. This is not a minus 3 lakh, my dear wonderful people. You'll think it as minus rent. Where is the concept of minus rent? You'll give the property also, you'll give the rent also, no? That is going to be 3 lakh. Some intelligent people of India would be thinking like that, out of the box, out of the universe sort of thing. So fine, let's come back. Whatever is, where is it? See, 3 lakh. Okay. Municipal tax I told you 35,000 plus 1,50,000, that is 1,85,000. NAV 1,15,000 minus standard deduction under section 24A 34,500. How did you get this? This multiplied by 30%. How did you get NAV? NAV is nothing but 1,15,000 into 30%. Done. So interest on loan is 1,50,000. That you will subtract how is given in the question. You will get it. Did you get income or loss here? You got loss. That is loss from house property is 69,500. Arrears of rent, however, you have this 30,000 and the deduction of 9,000 you have 21,000. What you will do is that basically you will do the net off. That is 69,500 is the loss minus 21,000 interhead. That is the loss from where is it? Loss from house property would be how much? 48,500 would be a loss from house property. This is minus. Okay, loss from house property would be 48,500. Clear? Now let's get back to the capital gain point. Now, further, the assessee acquired the following additional points. Okay, regarding the sale property of Chennai. Further additional points are given in the question. This Mr. Singh's father acquired a residential house in 1,25,000 in April 2006 only. And it was received by Mr. Singh on 1st March 2007. That is the way of inherited. Okay, it is by the way of inherited. Tell me, what is the indexation? If you consider the property, that is similar question we have done before. Mr. Singh's property, Mr. Singh, whatever he has sold, that is be inherited. The cost of the property will be the cost of the previous owner only. Clear. For the purpose of indexation, it will be, you can follow either, that is consider the 6 or 7 in case of Mr. Singh, or a year also it will be 6 or 7 only. In this case, both are same. If it is different, you will consider either as per 49(1) or either as per Manjula Jesha case law, which we have seen in the earlier question. As per that, you would consider. Here, there is no problem. Indexation benefit, you would get it from 6 and 7 and 1,25,000. Provided if you have transferred your property on or that is before 23/7/2024, if you have transferred it after 23/7/2024, basically you have an option. You are an individual. No, you are an individual and you have acquired the property When was this property acquired? This property was acquired before 23/7/2024 only. Acquired before, sold after. When you have sold it, basically, where is it? On which was sold by Mr. Singh on 10th August. So you have sold it after 23/7/2024. You are a individual. You have acquired it before 23/7/2024. So you have an option either to pay 20% with indexation or 12.5% without indexation. You can take anyone. That is as per your wish. Okay, let's do the computation. The properties were gifted. This fellow sold it for 25 lakh. Stamp duty charges at the time of registration 13%, that is SDV, was 3,90,000 SDV. People, tell me how much is the SDV that you are going to get. This is stamp duty charges. Charges, that is the payment which you are doing, that is extra charges. What will be the stamp duty amount? Array, how will you actually consider the charges? Suppose if 1 crore is the stamp duty value, 13% means what you would have done? 1 crore into 13%, you would have considered 13 lakh. Very well. So if you want to calculate what is the actual base value of this one, that is what is the actual stamp duty value, what you will do? 13 lakh divided by 13% you would do, no? You will get 1 crore. This is nothing but this 3,90,000 is representing how much? 13%. If you do, how much would you get? You would get 30 lakh. Correct? You would get 30 lakh as your amount. What is the amount that you are going to get? 30 lakh will be your SDV, people. 30 lakh will be your SDV. Correct? So now you have SDV and you have sale consideration. You have SDV here and you have sale consideration here. Something should be triggering your mind, no? What is it? Section 50C. People, it states whatever is the cost of acquisition, whatever is your actual sale consideration, and say SDV you have in a decent manner. If your SDV is greater than 110% of your consideration, what is it? If your SDV is greater than 110% of your consideration, then you will consider, for the purpose of considering that sale consideration, you will consider SDV value only. If it is less than that, if the SDV is up to or less than, that is basically if it is up to 110% of the consideration, equal to 110% consideration also, you will consider the actual sale consideration only. Okay. Everyone, if you want to understand more about the section 50C, section 43CA and section 50C are similar. As the that particular video is being posted in my YouTube channel, you can go and search over that. There I have given a very clear explanation. Clear? I have given a very clear explanation over this, stating how you will calculate 43CA. That point is good. Okay. So what now we are going to consider? 110% of the consideration is what you are going to take. That is out of the sale consideration received on 2/1/2025. What this fellow has done? This fellow has purchased 2 adjacent flats in the same building, suitable modification of 1 unit, and he has taken it from a separate sale deed of 8 lakh and 7 lakh. People, this is the question number 2 or 3, whatever we have seen, or question number 2, where we have seen the case wherein the one adjacent property, that is 2 adjacent property, has been considered, and these 2 properties have been made, that is a door has been set in the 2 properties, modified in such a way that it will become 1 property. And the assessing officer now had given the transaction, that is he had given the exemption only for, under section 54, only for 1 property. The court case told that it is available for both the properties. The same thing is available here also. Okay, you will get the exemption for both 8 and 7 lakh for that matter. 10 lakh rupees invested in national highway. This is going to be under section 54 EC and this is going to be under section 50. Clear? Now, see, the full value of the consideration is given here in the question. SDV, the full value of the consideration is your SDV. Why? Because your SDV is greater than 110% of your sale consideration. How much is your sale consideration here? 25 lakh. SDV, I have told you the calculation, 3,90,000 divided by 13%, you get 30 lakh is your SDV. 110% of your actual sale consideration is nothing but 27,50,000. Your SDV is greater than that one, no? Your SDV 27 lakh 50,000. 30 lakh is greater than 27 50,000. So your full value of consideration will be your HDV only, not your actual sale consideration. Clear? Now your cost of acquisition given in the question is 1,25,000. You will take it. And under section 54, you will get both 8 lakh and 7 lakh as your exemption, and 54 EC also you will get. That is nothing but your long-term capital gain will be 3,75,000. So now, as this Mr. Singh is an individual and he has transferred the property after this date, but he has acquired it before, he can either consider 20% long-term capital gain with indexation or 12.5% without indexation. In the question, they just ask the tax liability, total computation, total income. You have just calculated the total income. If they would have asked tax liability, only then for God's sake calculate tax liability. Okay. So the next question would be SSP Limited, wherein this is the concept of a demerger, people. When the demerger happens, how do you treat the capital gains report? See, the Indian company having two undertakings basically engaged in the cement decided to hive off Cement Private Limited, means they decided to split. It's nothing but a demerger. There is the A Limited, AB Limited. Now the AB Limited wants to get splitted into A Limited and B Limited. That is what they are stating. Okay. So now whatever this point they are recording is very simple. There is SS Private Limited, right? This SS Private Limited decided to demerge itself into SS Private Limited and the RV Private Limited. Fine. This is an Indian company, very important point, Indian company. And by way of demerger. The net worth of this SS Private Limited before the merger was 40 crores. That is basically their business valuation. Net worth was 40 crores. And after this, the net book value of this one was 10 crores. That is nothing but out of 40 crores which they had in total, 10 crores they have given to this demerged company. They are telling like, hey, Papa, you're going out of my SS Private Limited hold. You do one thing, you keep this 10 crore rupees with you, keep safe. The demerger was happened in January, very well. In the scheme of demerger, it was fixed that each equity shares of SS Private Limited, 2 equity shares of 10 each were to be issued. Okay. Mr. N and K individual holding 25,000 equity shares in SS Private Limited, which were acquired in the financial year 2004 and 5 for 6 lakh. Mr. NK received 50,000. That fellow who was holding shares in SS Private Limited, now he is getting shares in where? RV Private Limited. In the case of at the time of demerger, and he sold all the shares in March 2025. Fine. In this background, you are requested to answer the following. Does the transaction of the demerger attract any income tax liability in the hands of SS Private Limited or Private Limited? See, whenever the demerger is happening between the company, whenever the demerger is happening under section 47, the demerger is, logically speaking, it is not the actual transfer that is happening. We are not going to treat it as transfer only. Because one company being split into two companies, no one is paying from the outside. No, it is just that the business division is happening. That's it. So in that case, whenever the demerger happens, it will not create any tax liability. It is not considered as transfer only, and hence it is not considering any tax liability for SS Private Limited and RP Private Limited. Okay. Compute the capital gain. That is, this is no tax liability would be created. Very well. Okay. Compute the capital gain that would arise in the hands of Mr. MK. Again, see, if there is any shares that would be received by the shareholder of the before demerged company, that company was already holding shares and now is getting the shares of the demerged company. This is in the consequence of demerger, is receiving it. In that case also, it would not be regarded as transfer. Hence, there will be no tax liability that would be reflecting. There is no capital gain that would be reflecting in the hands of Mr. N and K. Okay. Compute the capital gain that would arise in Mr. N on the sale of shares. However, when he sell it to the outside market, he sold the shares for 8 lakh. This would result in capital gain because now he has sold it outside. How do you determine sale consideration? As usual is 8 lakh. How do you determine the cost? This fellow has paid how much? 6 lakh rupees for the purpose of buying. People think, see, how much was the SS Private Limited's net worth? 40 crores, correct? 40 crores was the net worth of SS Private Limited. This is nothing but 40 crores was the net worth when he has invested the money of 6 lakh rupees in that 40 crores. Out of that 40 crores, he was having, 6 lakh is the cost amount which you had invested when their net worth was 40 crore. Now their net worth is how much? 10 crore. How much will be your cost of acquisition to regarding to that? This is a simple cross multiplication. If you do, you will get 6 lakh divided by 40 crores into 10 crore. This is nothing but 6 lakh is the benefit, 6 lakh is the cost which I paid for the worth of 40 crore worth of asset. Then how much is the worth of asset which I would have if the whatever the this 10 crore rupees net worth for the company is 10 crore. See, I'll repeat. If 6 lakh is the cost which you have paid when the company's net worth was 10 crore, how much would have been the cost that you would have paid if the net worth was only 10 crore? How much you would have paid? You would have paid only 1,50,000. So your cost of acquisition which is allowed is only 1,50,000. So the LTCG which you get 8 lakh minus 1,50,000 will be LTCG 6,50,000. Okay. I hope you have understood. Will the sale of shares by NK affect the tax benefits? Array, how will it affect here? I being an individual, I want to make some money. I have sold it. So how will this affect the company for that matter? No, this will not affect the company. No sale will be affected by the company. Is Mr. NK eligible to claim any exemption? You only tell me under income tax is he eligible to claim exemption on the sale of these shares. See, people under section 54F, you can sell the any capital asset. No? You sold the capital asset and this fellow's individual, you will get under section 54F. So under section 54F, you will get the proportionate one. That is under section 54F. If we invest the entire capital, not just the capital gain, you should invest the entire consideration, you will get the gain. You will get the exemption. If we invest less than the net, whatever the capital consideration which you have received, you should be investing not only this amount, you should be investing this amount to get the entire capital gain exempted. If you invest something less than this, you will get the proportionate capital gain exemption. Simple? Clear? Okay. So now, in case of question number 11, that is PQR Limited has 2 units. One engaged in the manufacturing of hardware and another one software. Okay, as restructuring right, they decided to do the slum sale of 385 lakh for which unit? For the software unit. They are thinking of selling the software unit. And the software unit information is given here. Okay, fine. So the balance sheet information as on 31st March 2025 is given. The paid up share capital, general reserve, security premium, revaluation reserve, current liabilities of hardware and software unit, fixed asset, debtor and all these things, software and hardware units information is given. The additional information which they have provided is software unit is in existence till May 2015. And which year they are selling it? They are selling it in 2025. So is it going to be long term or short term? It's going to be long term. If it is held for a period more than 36 months, then it is going to be considered as long term, right? It is whatever the gain which you are going to get is long term capital gain. Okay. Fixed assets of Software Limited includes land which was purchased at rupees 40 lakh. Purchase price of the land was 40. This is going to be important. Remember, 40 is going to be important. Okay. In the year 2016, revalued at rupees 60 lakh and the stamp duty value is 55. Alright, stamp duty value as on this date is nothing but the fair value. No, it's nothing but the fair value. So what is it? This is the fair value and revalued at 60 lakh means there is a revaluation surplus which has been added, revaluation reserve which has been added, which is there over here to the extent of 20 for the land. Remember, for the slum sale, you shouldn't consider the revaluation surplus because the revaluation reserve, all of us know how the revaluation reserve would be created. That is, if you are increasing your value of land on one side, if you are increasing your value of land on one side, bringing it to the fair market value, suppose bringing it to the fair market value as on that date, you will increase your revaluation surplus also on the other side for that matter. So what will be your entry? Asset account debit to revaluation reserve. So this will increase the asset on one side and this will increase the revaluation reserve on another side. Both will happen. So whatever this revaluation reserve which has happened, is it the actual increase in whatever the asset that has happened, or is it just the book increase that you have done? In order to show your asset at the fair market value, you have done this. So this is not the actual gain. You will not consider the revaluation increase. Whatever the money which you smoothed out of the pocket to the extent of 40 lakh will be considered as your cost. People, all of us know, if cost is more, then your capital gain which you would get is less. You money which moved out of your pocket is only 40 lakh. Yeah. Why will the income tax allow you, just because you made the revaluation, why will the income tax allow you 60 lakh for that matter? Think, if that was the case, this fellow would have revalued it to 160 lakh, stating that my 100, that is to the extent of 100, I can decrease my capital gain. Correct. So revaluation reserve to the extent of 20 is not allowed. That is nothing but your cost would consider or include only 40 only. Remember? Great. Okay. Done. The next point. Fixed assets of the software unit 140, 200 minus the land value of 60, fine. Excluding land, they have given this 150, will consider. This is the WDV of depreciable asset. Okay. Plant and furniture machinery as per the books. However, the written down value of these assets as per the income tax, is 90. Now, asset in the tax liability under the slum sale, thinking that he has not opted for 115 BA. This last point, we'll come back to it later. First, we will do the solution. Okay, see, under section 50B, that is the slum sale, how you would do the computation is that first you will take the full value of consideration, you will subtract the cost of acquisition, you will get the long-term capital gain. Right? So easy. Wait, picture is just start. How do you consider the full value of consideration over here is going to be your fair market value 1 or your fair market value 2, whichever is higher. So now what is this fair market value 1? Whatever is the fair value of the assets and the liabilities, that will be the total, or the fair market value 2 is nothing but whatever the actual money which you have received. In this case, what is the consideration that you have received? 385. Your fair market value 2 is already fixed. This is 385. This we already know. Okay. Now we have to find what is the fair market value as per fair market value 1 to see whichever is high. How do you determine the fair market value 1 is nothing but your fair value of the asset and liability. Land, I told you the fair market value as on 31st March for the land is going to be 55. This 55 would be considered over here. 55. Correct? 55 would be considered. Other fixed asset given in the question, 140 will take. Debtor, nothing given in the question, you will consider it as per your balance sheet only. This is only considered as per your fair market value. No information is given about it. 110 and 35. So your total asset is 340 and the liability which you have, liability information is no information regarding to liability is given in the additional information. So we'll consider the liability of the software unit. Remember, you should not consider total. We are selling software unit, but the information which they have given it for both hardware and software. So we should consider only for software. Clear? How much is it? 90. You will consider. You will subtract this 90 and then whatever the answer which you got, 250 will become your full value. That is, will become your fair market value, 250. So now tell me, you got the answer for this. That is the 250 fair market value 1. This or this, whichever is higher. Which one will you take here? 385 only. No, this one you will take. Correct. Now, cost of acquisition. Cost of acquisition is nothing but the net worth. Net worth of is nothing but asset minus liability. Clear? Now, when you're considering asset, Govinda, don't take the fair market value of the asset. Net worth is asset and liabilities of the balance sheet. And here, for the asset, you have two, depreciable, non-depreciable. Depreciable asset, you have to take the WDV value as per the income tax. If that is not available, then you can take as per your whatever the books you have maintained. First, you have to consider, give the priority as per the income tax only for that matter. See, WDV book value of the non-depreciable assets 40. So something but the land, actual cost of the land, actual cost is nothing but it decreases your capital gain. So they want to give you as less cost as possible as the deduction. Understanding the point? So 40. 110 given in the question. Where is it? See here, 110 and 35 given in the question. Where did you get that 40 from? That is there in your fixed asset software unit. That is nothing but it's there in your question only. So much you have taken here. WDV of depreciable asset is 90, and this current liability we have already seen, and the net worth whatever you got is 185. This is the 185 net worth which you have got, and that net worth you are going to take it as a subtraction. Now you got the LTCG, long term capital gain of 200, and then this is under section 112, wherein it will be taxable at the rate of 12.5% on this 200 lakh, because the sale has happened on or after. This is happened on or after 23/7/2020, so it is going to be 25 lakh. And surcharge you are going to add. How do you get the surcharge, people? 25 like into 7% surcharge you will get on the total. You will add HEC, and then you will get your long-term capital. That is your taxable tax liability on your long-term capital gain. Clear? Tax liability on your long-term capital gain. This is your slum sale. And there is the one more point given in the question. What would be your advice as a tax consultant to make a restructuring plan of the company more tax savvy without changing the amount of sale consideration? See, what you can do is that, see, first of all, what is this fellow doing? This fellow, PQR Limited, has 2 units. It is selling this software unit to another company, S Limited, wherein this PQR Limited is selling to S Limited. Okay, it's selling to S Limited. It is already holding how much? 74% of the equity interest in S Limited, and it is selling its software unit to S Limited. People, there is a provision in income tax where the transfer happens between the holding company and 100% wholly owned subsidiary, Indian subsidiary. The transfer happened between holding company and 100% wholly owned subsidiary, then it will not be regarded as transfer. There is no capital gain that will come into picture. Understand? So what is the tax advice that you can give is that, array, you're already holding 74%. No, you're a rich party. Do one thing. Buy another 26% of interest in S Limited first, and then do this transfer, so that you will not be paying any capital gain tax. Correct? That is the one. Otherwise, you do one thing, you do the demerger. No, instead of selling it, you do the demerger. So that will also result in not paying any tax. That is what given here. See, transfer of capital asset, your 100%, you would be exempting your capital gain because it's not regarded as transfer. Alternatively, if acquisition is not possible, then think of demerger, so that you will not pay the tax in that situation also. Clear? All these notes which you are seeing is there in Telegram channel here. You will get it. Okay. So let's do this question number 13 now. Mr. Shah, this fellow, see, this is a very, very good question, and you should definitely mark it as your exam question for sure. You have to practice this mandatorily before going to your exam. That is the day before the exam. That sort of importance this question has. This has multiple provisions which is coming into picture. This has the provision of the your advance forfeited on or before 1/4/2014. After that, your SDV, that is, you have to consider your consideration also. Many provisions are there. Okay, it's a very good question. This fellow, Mr. Sham, he purchased the property on what date? On 1979 only. Great grandfather's time. For 3,24,000. In addition, he also paid stamp duty value of rupees 3,50,000. And also paid how much? Stamp duty value of 10% on 3,50,000. Tell me, if 3,50,000 is representing 10%, how much would have been the stamp duty value at that point of time? Just for your understanding, 3,35,000 would have been the point. So, but see, on the stamp duty value of 3,50,000. No, so this is on the stamp duty value of 3,50,000. So, how much would be the charges that you would have paid? 35,000. Everyone, how much would be the charges that you would have paid, people? You would have paid 35,000. So now tell me, whenever you're considering the cost of acquisition, you should add all the costs which is directly attributable. No? So 3,24,000 plus 35,000. How much is the total? 3,24,000 plus 35,000. This is going to be 3,59,000. 3,59,000 is the cost as per now. In 2008, this fellow entered into an agreement with Mr. Mohan for sale of the property for 1435. Received 1,11,000 as advance. However, sale consideration did not materialize. He forfeited. People, we have seen the similar question before. If it is forfeited before 1/4/2014, if it is forfeited before this date 1/4/2014, Now, whatever the advance money that you have received, this will be adjusted against the cost. So now 3,59,000 is the cost which you have considered. That will be adjusted. What further we will see what is the cost going forward. For whatever the cost of acquisition which you are going to determine, from that you are going to subtract 1,11,000. This is nothing but you are going to subtract this 1,11,000 from the cost of acquisition. Clear? However, the sale consideration, this is fine. In May 2015, he again entered into a contract for the sale of the said house for 20,25,000 and received 1,15. She did not pay the amount. It was again forfeited. This fellow's nasib is only not good. Again, it got forfeited. But actually, in one way, this nasib is actually good. He's getting the money without transferring the property only. No, some side money is getting. But when did he get this? This is on or after 1/4/2014. Correct. This is on or after 1/4/2014. After this date basically. So this, what will happen to this 1,15,000? This will be considered as income from other sources in the year in which it is transferred. That is in 15/16 only. It is going to be considered as income from other sources. This year only you are going to record it as income from the other sources in 15/16. This will have no effect in your computation for PY 24/25, PY 25/26. However, Deepshika did not pay the amount. All these things done in August 2015. Sham constructed the first floor. 3,90,000. So, however, indexation benefit you would be getting. No, this is nothing but the cost of indexation. Sorry, this is cost of improvement. Cost of improvement. This is nothing but cost of improvement. Okay, cost of improvement. On 8th of November 2024, that is in PY 24/25, Mr. Sham entered into an agreement with Mr. Manish for the sale of such house, and now for 30,50,000 received 1,50,000 as advance through account pay check. Very, very important, account pay check. Mr. Manish paid the balance entire amount and Sham transferred the property in Feb 20. Mr. Sham paid the brokerage of 1% on the sale consideration. So 1% is the allowed consideration, allowed expenses to be deducted from your actual sale consideration. From your gross sale consideration, you will subtract this one and you will get your net sale consideration and your calculations will move on. See, is the transfer happened? Yes. Agreement date. This is the date of agreement, my people. First, 15th November 2024 is the date of agreement. And the date of sale is 20th of 2025 and he paid the advance through account pay check. See, whenever you are paying through account pay check, that's a concept with regarding to SDB. We'll see the question and we will come back to it later. On 1st April 2001, fair market value of the house property is 11,85,000. HDB is 10,50,000 on this date. That is on 1st April 2001. Why is this information given? People, this property was purchased before 1/4/2001. So now you have to get it to your cost of acquisition or to your fair market value, whichever is beneficial for the, basically whichever is beneficial. But it will be restricted to HDB. And I will tell you, I'll explain that concept of whatever I told. The HDB is 10,70,000. Fair market value is given. You already have the actual cost of acquisition. See, what is the provision states is very, very simple. Whenever you have purchased the property prior, cost of acquisition for the property which is purchased prior 1/4/2001, you can consider the cost of acquisition or your fair market value, whichever is beneficial for you. But in case of land building only, you have to make another comparison before doing the comparison which I took. That is, first of all, first thing what you will see when there is cost of acquisition given for the property which is purchased before 1/4/2001, you have to see HDV as on 1/4/2001 or fair market value as on this particular date. Whichever is lower will be allowed for you to compare it with your cost of acquisition. Clear? This or this, whichever is lower will be allowed. That is basically you will be considering that with your cost of acquisition. Point being very simple. See people, why is this provision brought is that suppose you have considered the fair market value as on 11,85,000. Suppose this HDB is not given only. Okay. Let's consider this HDB is not given. We have to just compare this and this. An option is given to you to consider the cost at 11,85,000 or 3,59,000. Which one will you consider here? It's obvious, and it's obvious you will consider 11 lakh 85 only, because higher the cost, lower is your capital gain. Correct. That is what you're doing here also. 11 lakh 85,000 cost of acquisition which you have considered here. 11 lakh 85,000 of the fair market value, whatever you have taken. If this was not available for you, you would have taken these two and you would have recorded 11 lakh 85,000 as your cost. Higher the cost, lower the capital gain. In order for this not to happen, or a fair market value, you can give some amount to some valuer and you can make it increase. No? That too 1/4/2001, who can go backwards and do all such research and all? Not possible. You can do some gimmick work over here. So the department is like, we know what you guys are capable. Let's do one thing. Only for land or building, however, SDV value will be there with us. That data will be there with us. We will keep SDV or the fair market value, whichever is lower, and whatever the lower amount which you have got out of these two, now you take whichever is option. Now you will take 10,70,000, which is restricted to SDV now. Clear? That 10,70,000 you will take. And whatever the advance money forfeited point which I told you, no, that amount will be reduced. And your cost, where is it? Sorry, this is not cost of indexation. Whatever the amount which you got, this amount will be considered as your cost of acquisition. Okay. This is your cost of acquisition, whatever you have got. 9,59,000, the year of transfer divided by base year of purchase. You will consider 100 only. No, 1/4/2000, that is 1/4/2001, or the year of purchase, whichever is later. In this case, the purchase was in 1979. You don't have the data. So you will take it as per 1/4/2001. You will consider. So your actual indexed cost of acquisition will be your 34,81,170. Cost of acquisition index, cost of improvement, we already know. That is whichever year the improvement has happened, that year will be your denominator CII. Year of transfer, you will consider so much. This is available. I'll tell you both the alternatives. The question is still pending. There's a lot to do in this question yet. Okay. Further, the valuation as per the SDV on 15th November is so much and 20th November is so much. 20th February is so much. There are two different dates here. Date of agreement on one side and date of registration on one side. SDV for both the data is given. Now we have to consider which SDV you need to take for the purpose of comparison in as per section 56. Remember, if you have sold your property and the advance whatever you have received is in account pay check, account pay draft, any other electronic clearance mode like RTGS, NEFT, debit card, credit card, whatever online banking mode you have done, if that is the case, you are a good person, you will give the SDV as per the date of agreement mode. People, whenever the property is being sold, when whatever the property might be, SDV value of the property keeps on increasing. Land value never depreciates, it will only appreciate. Correct? No? So, higher the SDV, higher the chances of you getting into the higher tax payable sale consideration. So, they're like, I will give you something lesser only. We'll give you 39 lakh only. Don't worry, we'll not give you 41 lakh. Okay. So 39 lakh you will consider. Now you will make the comparison between 39 lakh and whatever the sale consideration of 30 lakh 50,000. What is your actual sale consideration? 30 lakh 50,000. So 30 lakh 50,000. What is the 110% of this 30 lakh 50,000? Do it in your calculator, people. 33 lakh 55,000. No? Tell me, is SDV greater than or less than your 110% of the consideration? Your SDV is obviously greater than 110% of the consideration. So your taxable amount would be 39 lakh. That is sale consideration. Suppose you didn't pay advance, that is in account pay check. You would have paid in cash form basically. 41 lakh would have been your taxable amount. This amount would have been replaced by 41 lakh. Suppose if it was paid in cash. Clear? So now that calculation we have done, 30 lakh 50,000 into 110%, 39 lakh 30 lakh 50,000, that is 33 lakh 55,000 you'll get. This computation we've already seen. Correct. Why? Because it was paid in account pay check or account pay draft you have considered and you have taken it. Now, what have they asked? Compute the capital gain and also compute under section, compute the tax liability also they have asked. Okay, we'll solve the question. First point though, you have understood everyone. What is the sale consideration? What is the percentage, people? How much? 1% of sale consideration to the broker, no? So now tell me how much is the 1% of sale consideration to the broker? 39 lakh into 1%. Array, you're wrong. I told you 1% of what? Sale consideration. People, money what you have got a sale consideration. Is it 39 lakh or is it 30 lakh 50,000? Govinda, it's 30 lakh 50,000. 39 lakh is considered only for the purpose of taxability. Money which you got is only 30 lakh 50,000. So 30 lakh 50,000 into 1%. Please be careful. Don't make the mistake over here. 30 lakh 50,000. Let's say consideration. Index cost of acquisition. We just saw those 2 points over there. Index cost of acquisition. Where? Index cost of acquisition. Correct. Done. Clear. So you are resulting in short-term capital loss. See now, when is this property being transferred, people? On February 20th, 2025. This fellow is Mr. Shah, individual. This property was acquired before 23/7/2024. It means he has the option. He can either go for 20% with indexation or he can either go for 12.5% without indexation. We will solve both the alternatives. Okay. So now whatever you have done here, this is nothing but the short-term capital loss which you have got for option 1 LTCG at 20% with indexation. Okay. Suppose if you wish to pay 12.5% without indexation, what you would do? Full value of the consideration, this point, whatever you have seen is the same. This is also the same. Cost of acquisition, whatever cost of acquisition you have taken here before indexation, no, this itself becomes your cost of acquisition. It is just that you will not get indexation benefit, but all these provisions, whatever you have done is the same. It is going to be how much? 9,59,000. Cost of improvement already given in the question, 3,90,000. Your LTCG will become 25,20,500. If an option is given to you only, you can take short-term capital loss, you will not pay in a single rupee only. Long-term capital gain, pay 12.5%. Which one will you opt here? Obviously, you will opt for the option 1 where you are not paying tax. Correct? See this, whatever the amount which you got, 25,20,500, you pay tax at the rate of 12.5%. HSA will be at the 4%, and the answer what you got, you have considered over here. Clear? So this is a very, very, very good question here. Very good question, comprising of many provisions, having the alternatives also. So it's a very good question for your practice. Okay. So the next question, that is your last question in your test your knowledge, that is your determine the capital gain or loss basically for the listed equity share. STT is both paid in both ways. This is listed equity shares and units of mutual funds STT pay basically. And they are asking you, this point 1 is with regarding to the shares and the point 2 is with regarding to your mutual funds. So let's do one by one. Mr. Prashant purchased 300 units at the cost of 400 per share. At what date? On 20th/7/2017 only. He has sold all the shares on 31/5/2024 for 12,500. And the price at which the shares were traded was on 31/1/2018 was so much. See people, the provision states that under section 112A, wherein you are selling the shares for that matter, shares or equity oriented mutual funds, if you are selling those, the sale consideration you are going to take at whatever the price you are taking. Okay. How do you determine the cost in this case? Would be you will take the actual cost of consideration. And then you will take the comparison of two things, that is the fair market value as on 31/1/2018 or your actual cost of actual sale consideration, whichever is lower. Everyone. So why do you take the fair market value as on the date of 31/1/2018? I'll tell in a very short sense. See, before 31/1/2018, your long-term capital gain was completely exempted. After that, what happened? After 31/1/2018, they made it as taxable. Now people started crying. Before I would have known, I would have sold all the shares before 31/1/2018 only. Now I'm holding the property from long time. Now I should pay the capital gain tax for the entire thing. Now the people are like, government is like, don't do overaction, don't cry. I'll finish first. They told, whatever is your fair market value or your actual sale consideration that you've got. Actual sale consideration is 2,10,000. If you would have sold your share as on 31/1/2018, you would have sold it at 1,20,000 only. Suppose you would have sold it at how much? 1,20,000. This is the fair market value as on this date. No? 1/2/2018, it was the budget. Announcement was made. Before that, if you would have actually sold, you would have sold it at this price before the announcement. So up till year 1,20,000, don't worry, I will not make it as taxable for you. That is, see, fair market value is 1,20,000. Okay, just take the totals now. I'll explain the question later. My actual sale consideration is 2,10,000. It means whichever is lower, I'll consider for the purpose of my cost of acquisition calculation moving forward. Whichever is lower, 1,20,000. Now it is 1,20,000 or 3,60,000. I actually paid out of my pocket 3,60,000. So 3,60,000 will be allowed as my cost of acquisition. Higher the cost, lower the capital gain. Suppose we will take another situation. Instead of 1,20,000, let's consider the situation. It is some 3,90,000. Okay. Suppose you would have sold on 31/1/2018. You would have sold to maximum of 3,90,000. Array, but the maximum amount that you're getting, money which is coming in, is only 2,10,000. No. Array, you would have sold at 3,90,000. It means if your sale consideration was to the extent of 3,90,000, I wouldn't have considered any tax. I wouldn't have collected any tax from you if it was 3,90,000. Understand? So now whichever is lower, I'll consider 2,10,000. This 2,10,000 becomes my higher point. This 2,10,000 I'll compare with my 3,60,000. Whichever is higher, that is 3,60,000 would become my cost of acquisition. Clear? Everyone done? See now, and another point. When these three different amounts are given, trading highest average rate and lowest rate. On 31/1/2018, remember, always take the highest trading price only. 31st March 2018, they are like, we will give you highest maximum benefit. That is cost of acquisition. We will give you as highest one. That is the 700 in this case. Clear? So, what is your sale consideration, people? First of all, 1,200 multiplied by 300 shares. So 1,200 multiplied, where is it? Just a minute. Your actual sale consideration should be 1,200 into 300 units, people. How much is it? 3,60,000 here. There is some mistake. There was a small alignment problem. So fine, no problem. Mistakes tend to happen when we are doing it in a flow. So net sale consideration, how much is it? 1,200 rupees. 1,200 rupees is net sale consideration for 300 shares. No, so it's going to be 3,60,000. And what is the actual cost of acquisition? 700 rupees is the actual cost of acquisition. Where did you get 700 here? So 700 is the actual cost of acquisition. You multiplied by 300 shares. How much did you get? 2,10,000. So the lower of the following, there is a fair market value as on 31/1/2018 shall be 1,20,000. We already know that is 300 shares multiplied by how much is the fair market value, people? What is the actual cost of acquisition? Cost of acquisition is 400 per share, and this one fair market value is 700. So now actual sale consideration is 1,200 rupees, people. 1,200 is your actual sale consideration. Okay. What is your cost of acquisition as on fair market value as on that date is 700. And what is your actual cost of acquisition is 400. So we'll represent the same. 1,200 rupees into 300 sale consideration. Actual cost of acquisition is 400 rupees per share into 300 shares, 1,20,000. And your fair market value we have already considered. 700 into 300 shares is so much. Actual sale consideration is nothing but the same amount. So how much would be your LTCG? If you subtract these two, you will get the LTCG as 1,50,000. All of us know under section 112A, excess of 1,25,000 will be taxable at the rate of 10%. So we are going to consider 2,500 and HEC will be at the rate of 10%, and the taxable amount would be 2,600. Clear? So the second point, whatever we are stating, is similar to the first point, but there is one addition to it. This fellow, Mr. Raj, he has 2 units. That is, he had purchased units from fund A and fund B, 200 each. 200 for this one, 200 for this. And yet the cost was 550 per unit. Fine. These were not listed at the time of purchase, but funds A were listed on 1/1/2018. That is before this 31st Jan 2018 only. This was listed. Okay. As on 31/1/2018, do you have the readily available price, fair market value? Yes, you would take the 750 as on 31/1/2018. Okay, highest one. But for fund B, these were listed on 1/2/2018. That is 31st March, 31st Jan 2018. If you don't have the fair market value date, you will consider the NAV. You will consider the NAV as on 31/1/2018. Okay, that is the only difference here. For the purpose of the fair market value calculation, for fund A, you will take 750 and for fund B, you will take 950. That's the only difference. Apart from that, everything else is the same. See, you will take sale consideration, you will take the cost of acquisition, and you will take whatever the fair market value as for the fund A is going to be 750 into 200 units, 1,50,000. Actual sale consideration will whatever is there is the same thing which you have considered here. LTCG you got, and fund B 900 rupees per unit, 200 units you have, and the actual sale consideration is actual sale consideration only you will consider here. Fair market value we already saw. Where did you get this 900? Look into the question. Sorry, this is 950. Please change it to 950 only here. I'll change it to 950. Where is it? Fund B. This is not 900 people. This is 950. This is 950. So 950 into 200 units. You'll consider, no problem. You will take it as 1 lakh. So 1 lakh 950 is the point. That's a small error. 950 into 200 units, 1,90,000 or 1,80,000, whichever is lower. Obvious, you will take 1,80,000. 1,80,000 or 1,10,000, whichever is higher. Obvious, you will take 1,80,000 only. You will take 1,80,000. Sale consideration is 1,80,000. So your LTCG will be nil. In the fund B, in the fund A cases, you will get 30,000. Both combined, however, both the long-term capital gain combined for Mr. Raj, it's going to be less than 1,25,000. Hence, that is not taxable. Okay, so these are the questions of your points of your capital gain. Test your knowledge. All the questions being explained, and this whatever you have seen, this is available in your Telegram channel, the notes for that matter. So thank you so much everyone. We'll meet in next video.